Hello everyone, this is Wade Hobbs from Levvel, and I thank you all for joining us here in this webinar focused on disruption in financial services. We're delighted to have you here, whether you're here from banking, retail, insurance, or any other area of financial expertise. Just a few housekeeping notes to get us underway. During this webinar, I want to encourage all of you to make this a very personalized experience by submitting questions to me and our team using the online tools provided. We'll answer as many as possible during our time together today and follow up on the rest via email after the webinar is over. If you have any technical difficulties at all, use the live support link in your browser to have one of the experts from Bright Talk reach out to you immediately. And finally, a recording of this session will be available 1 hour after the completion of the webinar. So send the link to your friends and colleagues and email us directly at payments@levvel.io. This session is being brought to you today by Levvel. We're a full-service consultancy based on helping our clients succeed through technical innovation. We perform a variety of services with expertise in payments and financial solutions, design services like UX and customer journey mapping, and a variety of software-related fields, including cloud development, DevOps, and application build. Again, email us at payments@levvel.io for more information. By way of personal introduction, I'm Wade Hobbs, Head of Business Development and Strategic Partnerships here at Levvel, and I'm pleased to be joined today by my colleagues Greg Lloyd and Mary Mead from the Financial Services Practice here at Levvel as well. Greg, if you would please take a moment and introduce yourself.
Great, thanks Wade. Hey, it's a pleasure to meet you all. Good afternoon. Again, my name is Greg Lloyd. I'm a Senior Director in Levvel's Financial Services Practice. My responsibilities include overseeing the majority of our client engagements and managing our relationships with our accounts, where we work with all sorts of banks and financial institutions, all sorts of payments networks, both card and non-card, merchants, and all others in between.
Thanks, Greg. Glad to have you here with us. Also today we have our colleague Mary Mead with us. Mary, could you take a moment and introduce yourself, please?
Sure. Thanks, Wade. So my name is Mary Mead, and I'm a payments consultant at Levvel. I work with banks and other companies on their payment strategies, and I help them implement projects to achieve their goals. I'm really excited to be here.
Well, thanks very much. Thanks to both of you. And without further ado, let's go ahead and get underway with disruption in the financial services. So today we're going to talk about this topic, and it's as pervasive in financial services as any other, is disruption. And I know a lot of people hate that word and think that it's a misrepresentation of the state of change that's really going on in the industry. But we're going to look at it very closely and identify 3 key areas where we think the pace of change is likely to have a lasting impact on the incumbent market leaders. First, we'll talk about open banking and the effects that allowing increased access to bank data is having on experience creation, both here in the United States and abroad. Next, we'll take a look at some of the new entrants in the financial services space. We'll pay special attention to technology players who are not native to banking, but are creating opportunity and taking leadership roles in the financial space. Finally, we'll round out our disruptor overview with an assessment of the ways real-time payments are going to impact every payment system in the U.S. Most payments professionals agree that new RTP systems are going to be complementary to current payment methods, but for how long? We'll talk about developments that will continue to bring value in new ways for years to come. As I mentioned earlier, there's really quite a bit of confusion about what disruption actually is. In the context we'll discuss today, it's quite simply the shift that occurs when customers' expectations change and new entrants show up to fill that void. That creation of opportunity and rapid market conquest could be catastrophic for industry leaders, much the same way Amazon has impacted brick-and-mortar retail. Online streaming services like Netflix have impacted the video rental and cable industries, and Uber's impacted the transportation market. But in many smaller cases, the results are minimal for the incumbent players until over time the small niche opportunities add up and shift customer expectations more broadly. Then once your customers expect some aspect of your business to be delivered in a different way, meaning faster, more relevant, or more intuitive, you can bet there's a technology that will meet that need. We've seen technology advances like artificial intelligence, the Internet of Things, and interoperable platforms springing up over the last few years. And what all this means to you is that you'll need to either move very fast to use these new capabilities or get ready for someone else to do it. So now on to our very first topic of the day. I'm happy to hand it over to Greg to talk a little bit more about open banking and the role that it's playing within the financial services space.
Wonderful. Thanks, Wade. And as Wade said, we're going to be talking about open banking here. And really, as you'll see on my title here, this is an opportunity to be a green field for banking. So let's first start with open banking and defining it a little bit. Really, what is open banking and how does it work? The key point here is that open banking is about flexibility and user control. Now, this applies both at the provider level, whether it be a bank or financial institution, or a fintech or other third-party provider, as well as at the customer level. From the bank or financial institution level, this is about controlling how data is accessed by third parties for your end customers. So you think about today in methods such as screen scraping, where anybody can give away their account credentials and then the third party can screen scrape what's on your website in the authenticated space of your website. By pursuing an open banking model, you can now, as a bank, control what information is accessed, what data, whether it's account data, balances, payments and transactions, information like that, the timing around which it's available and how long it's available, and then most importantly, the security of that data. Now, from the account holder perspective or the end user perspective, again, this is all about control. The first most important point is giving end users control and making sure they have the ability to give or not give consent on access. So the end user has control to give consent for a bank to share their information with a third party. On top of that, the control applies to other areas such as removing access, visibility into who has access. You may have forgotten about something from a year ago. And then again, the most important piece is having the trust and faith that the information is being shared securely. So let's talk a little bit about how this is disruptive. First off, from a bank perspective, banks don't very often get brand new revenue streams. We certainly see alternative revenue streams that are in line with things they get today, such as real-time payments being a new form of transactional revenue, and we'll talk a little bit more about that later. But open banking has the opportunity to be a brand new revenue stream for financial institutions, and this is the first brand new revenue stream that's come along in a long time. Now, the revenue opportunity here is with regards to banks offering a value, and that value is about a more reliable and secure way for third parties to access their data. And it's a value exchange of offering that value to third parties who want to use that data in return for revenue opportunities. This also provides acquisition opportunities as well for banks that may attract customers if those banks are more flexible and enable more opportunity and give more power to the hands of their users. The second thing is with regards to how financial institutions and fintechs partner. Now, this creates a better pattern for fintechs, third parties, and financial institutions to partner because it sets a standard by creating a set of specific domains, specific data, and creates some levelness and standards around how that information is shared. Third, this also removes barriers to entry, both from a banking perspective and a service provider or fintech perspective. The reason is because this allows people and companies to focus on their strengths. For example, if a company were a PFM provider, a personal financial management provider, or a budget provider, in the past, they would have to worry not only about their experience and their capabilities from a budgeting perspective, but they also would worry about how they enable customers to import their transactional data. And they might have to rely on, again, screenscaping or other capabilities, or perhaps one-off relationships with banks. And this makes it more difficult. By offering an open banking model, now financial institutions and fintech providers can focus on their core strengths. Give you another example from the perspective of a smaller bank. Now a smaller bank that might not have the ability to pursue all sorts of different experiences can focus on the ones that are most important to their customer set, and they can more easily partner with fintechs. And so that really creates a lot of disruption and opportunity for all those parties. The last one is around increasing the opportunities for innovation through those partnerships. That occurs by increasing agility, because now the fintechs and the banks can react more quickly. They can also implement new solutions more quickly. And also by creating those standards and that reliability, it also helps people be more comfortable with a base level of information and a base reliability that enables more flexibility above. Now that we've talked a little bit about how this is disruptive, I'd like to give a few examples of specific opportunities that open banking provides. First is talking about banking as a service. Banking as a service offers new capabilities to both fintechs and financial institutions. From a fintech perspective, now fintechs or third parties are able to expand the offerings beyond what they might have been able to in the past. Additionally, beyond just having more capabilities to offer, they also have more competition on the vendors they're dependent on, specifically the financial institutions. Whereas today, a limited number of institutions typically serve third parties with their banking charter. Now, by more banks pursuing an open banking model, you have the opportunity for these third parties to leverage a more competitive set of offerings. Similarly, from a financial institution perspective, now they have the ability to offer white label services or leverage services from other partners to offer within their brand and thus better capabilities and functionality for their customers. Second big opportunity is around identity. Banks are traditionally respected and appreciated for the level of rigor and data they put around security and ensuring that the person they're speaking to or the customer interacting is the person that they expect it to be. There's an opportunity to leverage this robust nature that comes with being a bank for third parties. For example, banks may be able to partner with government institutions and others to provide holistic identity services through these API connections, and they can do this in a safe and secure manner. Similarly, this could also be used to offer to other smaller third parties. For example, if you think about today where you might go to a website and you can log on with Facebook or log on with your Google credentials, now you might be able to validate your identity through your bank credentials, again in a safe and secure method that comes with an open banking framework. The third area I like to talk to is data sharing. We've spoken a little bit about data sharing already, thinking specifically about a PFM or budgeting tool set and how you might leverage that open banking to be able to offer something. But think more broadly, for example, entities such as a credit reporting agency or some of the other third-party entities that are trying to create credit reports. Think of companies like Affirm. They're dependent on a robust and reliable source of bank data to be able to properly assess a given customer. By working with banks that offer a robust open banking model, now the services that those companies can offer can become more reliable and more standardized and therefore more useful and better for the end customer. Now that we've talked about those three, let's talk about a few other opportunities in open banking more generally. First off, again, as I've mentioned before, open banking is creating a streamlined and standardized approach. Today, the environment is neither. Again, especially if you think about something like screen scraping, that can be very unreliable if a bank or institution were to change its website that requires rework. And so by pursuing open banking and creating that stable foundation, now there is an opportunity for banks, fintechs, third parties, and all others in the ecosystem to take a fresh look at use cases, both of the use cases that already exist in our environment, as well as looking for brand new use cases that might have been otherwise inaccessible or difficult to pursue in the past. Secondly, with regards to revenue streams, again, banks have an opportunity to look for revenue streams with regards to the data, the security, and the trusted position that they currently offer today. And they can leverage those capabilities to offer. This is meant to be a value exchange. It must be a value exchange. It can't be simply charging for something, but it needs to be about offering value. And again, the key points of value that banks can offer, in addition to the data, is the fact that they should be properly designing these APIs so that they're secure and they're consistent and they're well-defined to provide a consistent set of data to the users. Third, from an FI and fintech perspective, now they can better leverage each other's capabilities. Whereas in the past, it might be difficult to think about services, how you obtain services that you're not able to offer. From a fintech perspective, maybe it's getting access to a banking charter, or from a bank, maybe it's getting access to the best PFM capabilities or tool sets. Now it's more easy to leverage each other's capabilities. By using this open banking framework, both fintechs and financial institutions should take a fresh look at what they offer versus what they might want to offer and pursue new opportunities through partnerships. Finally, and then lastly, as I said in the beginning, open banking is about providing a greenfield approach for banking. Banks, fintechs, and others should leverage hackathons and other methods to recruit, gauge, and partner with new parties, as well as discover fresh ways to use the available APIs to better serve their customers. Open banking should be an opportunity to, again, take a fresh look at how the industry operates, both within banks and outside of banks, to figure out what we can all do together to better serve the end user and the end customer. With that, Wade, I'll go ahead and turn it over to you, see if there's any questions.
Well, thanks, Greg. I appreciate that very much. And we do actually have a couple of questions in the queue. Again, a reminder to all of you on the phone there, feel free to use that Ask a Question button and send those in. We'll take moments like this to answer as many as we can, and we'll get to the rest afterwards. Our first question is a very interesting one concerning risk management. The question reads, convincing my risk partners to open our platform will be very difficult. Is the banking industry working on something collaboratively that will help me get buy-in at my institution?
Yeah, absolutely. That's a great question. And there's two pieces really at play here. First off, to the specific question of whether there are efforts going on in the industry, I'd say the biggest one is coming from the clearinghouse, or TCH. TCH is working with financial institutions and others on a financial data exchange. And they're working with those in the industry to figure out what is the right way and what are the right methods and designs for APIs and what information should be shared and how should it be structured. And so that's one great example of how the industry is coming together, particularly from a perspective of being in a driver's seat to be able to design that out. So I'd say that's piece number one. The second piece, more generally, I would say, is that open banking is an opportunity for financial institutions to put themselves in the driver's seat for this. Whereas today in a screen scraping model, if a user gives away their username and password, any information might be available through the site. That has been a concern of legal, risk, and compliance partners for some time. Open banking changes the game. Now by taking control and determining what you will offer and how you will offer it and making it easier for fintechs and third parties to access your information, you're now creating a partnership where you have some control and you're working together with those parties in an active fashion. And so I think this should be viewed as an opportunity, and this is the way to best present it to those partners to help get them on board and understand what the real opportunity is here.
Sounds good. Thanks, Greg. We do have one more question in the queue here, and I think this is in reference to some of the comments you've made about Europe during the presentation here. The question reads, why should I be concerned what they're doing in Europe?
Yeah, that's another great question. And for those not aware, in Europe, they've got a regulation called PSD2, and there are several others out there as well, but I'd say that's the main one. And in Europe, they've been pursuing a more open model for some time now. And while it is true that the U.S. and the European markets are different, I think it's important to look at Europe as a leader as well as someone we can learn from. And this applies not only to open banking, but other parts of the industry as well. If you look at real-time payments, that also has been around in Europe for some time, and we'll talk about that again later. And open banking, the same thing. Open banking methodologies, particularly through PSD2, are being pursued greatly in the European Union right now. And so we have an opportunity, although we're a different market, to learn from what they're doing, see what's going well, what's not going well, take the use cases that seem to be getting the best adoption and decide how we'll address those. Now, one more thing to say about that is, while in Europe it's been pursued from a regulatory approach, in the U.S., I think most in the industry agree that we're looking to take a more organic approach and worry less about forcing things through regulation, but more from each bank's perspective, try to see how we might be able to put ourselves in the driver's seat, again, take a more organic approach in how we partner with institutions and pursue a model. And so it's really about approaching it from a product opportunity, less about a requirement to do something.
Excellent. Very good. Well, thank you very much, Greg, for that talk on open banking. And if anybody's interested more in open banking, I would, of course, encourage you, one, ask us questions through the webinar here. Two, reach out to us directly at Levvel. And three, take a look in the attachments and links through your BrightTalk platform there. You'll find a link to an open banking architecture design that we wrote some time ago. We'd be glad to talk with you about that separately, but by all means, download that and take a good look at it. So now moving on to the second topic in our view on disruption here, we'll talk a little bit about the new entrants that show up in the financial space. We mentioned earlier that as expectations change and technology advances, new players who aren't native to the industry will show up and fill in those gaps between what you offer and what your customers really want. Fintechs are realizing there's a lot of money to be made in taking small bits of larger incumbents' business, so new players are arriving on the scene more quickly than ever. Mary, if you would please, talk a little bit about these new players and how they're finding their fit in the financial services industry.
Sure, thanks, Wade. So as Wade alluded to, in this section we're going to talk about new entrants causing disruption in financial services. So this includes specific examples of new entrants using open banking, as Greg talked about, as well as some other examples. You may commonly hear new entrants referred to as fintechs, and fintechs cover a wide range of company types. The visual on this slide shows some common groupings where we see fintechs emerging with disruptive products. The groupings include things like payments, personal finance, lending, consumer banking, just to name a few. The first two examples we'll talk about include personal financial management, or PFM apps, and two banks that are taking different approaches to open banking to give their customers ways to track their spending. So let's talk about the partnership between TD Bank and Move-In first. TD Bank has created a PFM app in Canada called TD MySpend, which is a separate companion app to the everyday TD mobile app. MySpend was built using Move-In software and is branded by TD Bank, leveraging bank data retrieved from TD's open APIs. TD maintains the customer relationship and the user experience. The app looks like a TD app from the customer's perspective, and they have no way to know that Move-In software is being used. TD MySpend securely connects customers to their eligible accounts and tracks and categorizes their transactions. Customers can use the app to monitor their spending over time and even set up spending notifications and monthly goals. TD MySpend is disruptive because customers are ultimately happy with the product. So happy that the app has the #1 spot for free money management apps in the Canadian App Store. So other banks are taking notice. There is a broad opportunity for banks to partner with companies that have ready-made budgeting solutions. These solutions can increase customer satisfaction, loyalty, and even retention rates. Third parties can benefit from partnering with a bank because banks can oftentimes provide recurring revenue growth and the scale needed to be successful, like Move-In in this example. My second example is Chase and Intuit's partnership, which also leverages open banking for PFM. In this case, Chase has an API that Intuit consumes for their PFM tool Mint, and Intuit owns the user experience. Mint is great for people with accounts at multiple companies who want a unified experience to see all their financial information from banks, brokerage firms, insurance companies, etc. Previously, Intuit would request their customers' bank login credentials to screen scrape the data, usually collecting more data than they needed in order to extract the information that they needed, and then populate the Mint experience. With Chase customers, Intuit can now use Chase's API and directly get the customer's financial information from the bank. The bank can control access to their data. Chase can control giving Intuit only the data that they're comfortable with sharing. Intuit can more efficiently get the data they need to populate the experience without extracting additional information. The relationship between Intuit and Chase can be considered disruptive because Mint's already considered a top financial management tool and customers are already using the product. But Intuit can offer an even better product using more accurate customer data directly from the bank and provide more features. Also, customers will want to bank with Chase because of their open APIs. Customers know that their data can be easily synced with popular products in the market, such as Intuit's products, if they bank with Chase. So Intuit also uses open banking and data aggregation APIs to gather information to use within TurboTax as well. Ultimately, there's an opportunity for banks and third parties to partner to create more robust customer experiences and aggregate financial data all in one place. My third example of open banking is a partnership between Stripe and Silicon Valley Bank. The Stripe Atlas product is a tool designed for founders of internet and technology businesses to get up and running. Atlas is disruptive because it offers a simple package for fast-moving startup companies, and it provides them with the confidence to move forward. For a flat fee of $500, Atlas includes things like U.S. company registration, registering with the IRS for taxation purposes, a Stripe account to accept payments, and even a zero-balance U.S. bank account in Silicon Valley Bank, and the list goes on. So Stripe is leveraging Silicon Valley Bank for account opening. When looking at opportunities to create disruption, companies should look at a mutually beneficial partnership. In this example, Stripe benefits because adding a business account adds to Stripe's existing capabilities. And Stripe probably didn't want to be in the business of building an account opening process when they could take advantage of Silicon Valley Bank's existing process. Speed to market is really important when you consider creating disruptive partnerships. This relationship is also great for Silicon Valley Bank because it increases the bank's footprint and the number of accounts opened. Also, Atlas founders may decide to deepen their relationship with Silicon Valley Bank and get additional products. Next, let's talk about Grab and MasterCard. This is a newly announced disruptive partnership within the financial ecosystem. Just like Uber and Lyft dominate ride-hailing in the U.S., Grab dominates the ride-hailing market in Southeast Asia. Grab's customers can book rides from the app and pay through the app with a debit or credit card, or customers can choose to pay with cash, which is the predominant method of payment in Southeast Asia. Grab is partnering with MasterCard to offer prepaid cards to their users in 2019. Users can apply for a MasterCard directly via the Grab app and receive a physical or virtual card. The prepaid card can then be refilled via a linked bank account or by handing cash to a Grab driver or a retailer. The card can be used like any bank-issued MasterCard to buy goods and services online or in-shop. And the reason why this partnership has the potential to be so disruptive is because, according to Grab, 3 out of 4 Southeast Asians, which is more than 400 million people, remain unbanked. The World Bank claims that just 30% own a debit card and 9% have a credit card. So this will be the first opportunity for many Southeast Asian consumers to go beyond cash and use the global card infrastructure. The broader opportunity to note from this example is that financial institutions can look at unbanked markets and partner with companies that have a strong presence in those markets. There may be a growing need or desire for financial services. Credit Karma is considered a fintech unicorn because they have more than 80 million members. Before Credit Karma, obtaining a credit score and understanding your credit was not as easy. We had to apply for credit reports from each of the big credit reporting companies like Equifax, Experian, and TransUnion. then we had to purchase our scores directly from each agency. Consumers are interested in their credit score because it's one of the most important factors in determining their ability to get loans and new credit, and it has a major influence on their rate. So Credit Karma's product offers free ongoing access to credit scores and reports from TransUnion and Equifax. So customers, they can review their score as frequently as they want, they can check it for accuracy, and even identify ways to improve their score. When customers access their credit report, Credit Karma suggests credit products based on their current history. It also uses credit scores and history to determine which products come with high approval odds. The company gets compensated by matching consumers with tailored product ads that are based on their credit profile and the likelihood that they'll be approved. Credit Karma gets paid for this lead generation based on agreements with its financial advertising partners. So to be disruptive, Credit Karma, they had to successfully predict the needs of their customers and develop a unique product that made their customers' financial lives easier. I would advise companies to listen and take customer feedback to heart in order to predict what their customers want and need. Many banks today, they capture things like page-level feedback in their digital experiences. They have usability studies and even conduct surveys that can be leveraged to understand what customers want and need. Knowing your customers should help generate ideas on what new disruptive products to build. And my last and final example of a disruptive partnership is between ID Now and Erste Bank. ID Now is a German company that's developed a way to remotely verify a person's identity via a video chat. Erste Bank is using ID Now's product for account opening, which now takes less than 10 minutes according to the Australian bank. New customers can identify themselves directly via video chat, and that saves them the time and the effort that was previously required to open an account in a branch. You're probably wondering, how does this process work? So first, customers, they take a photo of their ID document, and Australian citizens, they can use passports, national ID cards, and driver's licenses to verify their identity for Erste Bank. And then second, the ID data is transferred to the relevant form. Then customers can fill in their personal data and then select a preferred bank branch on a city map using geolocation. And lastly, the customer's identity is confirmed on a video chat. So this process, it can be done via desktop computers as well as tablets and smartphones. This solution is disruptive because customers are becoming more digitally savvy and they expect to be able to do everything from their phones. When customers find out that they can conveniently do all of their banking at home at any time, they'll be happy to switch to an innovative and flexible bank like Erste Bank. As Wade mentioned before, companies, they need to stay in tune with their customers and make their lives easier because as a company, you want to be the cause of disruption and not the effect. Video conferencing, biometrics, and electronic signatures are starting to become a trend as banks move towards higher digital usership. There's an opportunity for banks to partner with companies that offer these products so their customers can have even fewer reasons to visit a brick-and-mortar branch. So I'm just going to pause here. Wade, do we have any questions from the audience?
Well, thanks so much, Mary. That's a very good overview of those new players. Yes, we do have questions in the queue at this point. The first question here, I believe, is going to contrast a little bit between the build versus buy aspect. The question reads, how should I make the decision about developing a new tech offering versus trying to partner with a fintech? Mary, what do you think of that?
I think that's a really good question. So it should depend on your company's circumstances, but I can give some general guidelines. So if there's a fintech with a great solution already developed, then you can go to market quicker by leveraging the existing solution. If there's a solution that is already predominantly being used in the market, like in the example of Chase and Intuit, then you can go with the flow and let your customers continue to use the solution that they're already used to using. But you can help contribute data and improve the existing solution through open APIs. If there isn't a great solution already in the marketplace, then it may be your only option to create the solution from scratch, like in the case of Credit Karma. So I think there are opportunities for banks as well as fintechs to create new solutions, especially now that banks are employing talented technology teams and doing a lot of their own development work in-house.
All right, fantastic. Good to know. We do have one more question in the queue here. And this one reads, how can I tell which fintechs I should partner with and which ones I should defend against? Any thoughts?
Yeah, so you want to make sure that you're in a mutually beneficial partnership. It's like a marriage. In all the examples I reviewed today, both parties experience benefit. So the fintech could benefit from getting revenue for their solution and having the opportunity to scale their solution or improve their experience with bank data and hopefully get good publicity. The bank could look to increase customer satisfaction or loyalty, increase their retention, gain usership or new customers, or even reduce manual processes that occur in bank branches or contact centers. I would say your best bet is to defend against fintechs who are looking to get access to bank data and give nothing in return. It's still good to have conversations with these fintechs and understand their need because it could propel new ideas or help both parties gain a fresh perspective to propose a new and better plan that's mutually beneficial.
Sounds great. Sounds great. Well, I really appreciate all of the discussion about those new entrants in the space, Mary. And before I move on to the final topic, our real-time payments topic, I would like to encourage everyone, please keep the questions coming. Use that Ask a Question button in your browser there. Send over questions, whether it's open banking, new entrants in the space, or real-time payments as we get into here. Feel free to send them along and we'll answer them. We'll answer everything we can during our time together, and we'll answer everything else via email after the session's over with. So please send them in. For now, though, we'll talk about real-time payments. And one of the very common themes we keep hearing about disruption is that customers are expecting things to happen faster. Customers expect everything more quickly, from getting packages in the mail to letting their friends know what they're up to on vacation. In terms of financial services, that begs the question of why it often takes so long to pay a bill or send money to another person. A full industry of new entrants has arrived to disrupt the traditional banking and payments market, and in the recent months we've seen the incumbents push back with new technologies of their own. So at this point, Greg, I'd like to turn it over to you to talk a little bit more about the movement towards real-time payments.
Great, thanks, Wade. And as you all can see this lovely map we have up on the screen, you'll see that there's already 30 countries live with real-time payments today. And there's another 15 that are in process or in development. Recently, Australia went live, the US went live at the end of last year, and Canada's coming soon, I think, in the first half of 2019. So this is really something that's coming strong, and really it will disrupt the industry. Now, before I get into why this is going to disrupt the industry, I want to take a moment and talk a little bit about how the solution works and what this is. Given it's still a little bit new, just want to give us all a level playing ground, if you will. So really, what is this real-time payment solution? Now, first off, I'm specifically talking about the solution from TCH, the clearinghouse. Pardon me. Now, this is the first new rail in 40 years. Well, of course, except Discover, but that was just another credit card network. Here, we're talking about a brand new rail. And this was designed and built through collaboration between TCH's 26 owner banks. It's powered by Vocalink, who is the vendor between the real-time rail in the UK, Singapore, and Thailand, and they were recently acquired by MasterCard. Now, the most important point here is this is a brand new rail, it is truly real time, and it is not just based on some other existing rail. Whereas some systems today may be real time on the front end, but behind the scenes they operate through ACH or wire or the card networks. This is a brand new network that stands completely on its own. Now this is a push-only system, and it provides immediate payments. And by immediate, I mean end-to-end, including settlement and reaching a state of irrevocability, all occurs within 15 seconds or less. And actually the first transaction that occurred last November was, I believe, 3.4 seconds. Now this is achieved through a single shared settlement account at the Federal Reserve Bank of New York. TCH oversees this account and manages this account, but all banks pool their funds based on their size and the expected volume into this single account. This system is already live with 10 banks today, and there is expected to be maybe 40 more in the first quarter of 2019. And by the way, as I mentioned earlier, this went live last year. We should actually have birthday candles here on the slide because happy first birthday to TCH's solution here, because it went live on November 13th of last year. So getting a little bit deeper into what the core functions of this system are. First off, as I said, this is a push-only system. That means there is a credit transfer message to send money. There is no pull. There is no ability to draw funds out of another person's account. Now, if a customer did want to ask for money, there is a request for payment request. And so a consumer can say, I'd like to ask for $50 from Wade because he didn't pay me back for a pizza last night. And so I can send that, and then Wade or the recipient would then create a new credit transfer message to send the money, but there is no way to pull the money. Now, two other messages here that are very critical to the system are the request for information and the remittance data. One of the most powerful pieces of this new system is the ability to share information and message across the system. For a request for information, users have the ability to ask a question or send some or request some information tied to a payment or a request for payment. So, for example, if I was expecting $600 and I only got $500, rather than in the old days I might have to go through some other vendor solution, or I've got to pick up the phone or text someone and say, hey, what happened? I can now directly in the system send a message, why is this only $500 when I was expecting $600? Now the beauty of this is not only can I do all the messaging through the system, but this is all tied specifically to that payment. So everything's linked together. I could send a request for payment, then send the payment, then request information about why the payment was done a certain way. Another piece of information sharing is remittance advice messaging. The system allows a user to send a remittance advice, which may be an invoice or maybe some other structured data, and send that along with either a payment or with a request for payment. And so now, next time I request money from someone, I can include all the details of that invoice along with the payment. And again, it's all tied together. Moving on, a couple other messages that are critical are the payment acknowledgement and the request for return of funds. Starting first with the acknowledgement, and I'll talk more a little bit about this later, but the system on its own always provides absolute certainty and absolute clarity. That's one of the best parts of this system. But what sometimes is missing is the ability for someone to acknowledge that they've actually seen the payment. There's quite a difference between me sending Wade the $50 for the pizza and Wade responding and saying, hey, I got the $50, thanks very much. Now I know he's seen it, and I know we're all square. I don't have to worry about him coming back later and saying that I never paid him. And so that's really powerful that now users can acknowledge a payment and that this payment sender can now know for certain that the person has seen it. Another thing, going to the request for return of funds, as I said earlier, the payments here are irrevocable. As soon as they settle within that 15-second window, they are irrevocable. And therefore, if I sent a payment in error, the only way to get that money back is to ask for it back. So I would submit a request for return of funds, and then that would process through. That's obviously an important message given that there is the opportunity for customers to make mistakes, and so there'll need to be proper ways to manage that. Now moving on to the last two here, I won't get too deep into these, but at a high level, the system also comes with a lot of robust messaging to ensure absolute clarity. Some of these messages, whether it be the control messages, the system notifications, or the administrative advice messages, some of these are to provide notification on what banks are online or offline at the time. Some of them are around specifically for my bank. Perhaps my balance in that single funded account is too high or too low. There are also messages about my specific, as a bank, the specific messages I've sent. So for example, a payment could have failed or a message could have failed because it may have timed out, or because there may be a syntax or perhaps a security issue with the digital signature of that message. And so the beauty of all that messaging, that real-time messaging that comes alongside this real-time payment, is that they ensure that there is always absolute clarity to any message and any payment. In other words, to give an example, if I sent a payment and within 15 seconds it didn't clear through, it would time out and automatically fail. So now we've got a solid understanding of the core functions of RTP. I'd like to move on to talking about how this is disruptive. So first, number one, key point here is that these are instant and irrevocable payments. And again, this is end-to-end, including settlement. From the moment the payment is submitted into the system, the moment it's back fully acknowledged, both the sender has the money pulled out, the receiver has the money in their account, and both banks are square, is 15 seconds absolute maximum. And so that instant and irrevocable payment is hugely valuable in a lot of areas. I'll talk a little bit about some of them in a moment when I get specific to opportunities, but this is disruptive because this helps reduce the risk and the complexity and the uncertainty that comes with many payments today. Second thing, as I said earlier, is now, as part of this being instant, you also get a guaranteed status. As I talked about the messaging with having canceled payments if it doesn't clear in the appropriate amount of time, now I know within 15 seconds that that payment has been received. I have a guaranteed status knowing that. There's no more concerns with payments that are in a limbo or in process states for longer than a few seconds. And so therefore, particularly in business payments where that certainty is critical, you now can get that certainty crisply, clearly, and quickly within your systems. Third thing is, again, as I said, about sharing information and the communications. Now, because I can do this all within a single system within my bank, I can now ask questions, get invoice data, confirm an amount, confirm why something's different, and do all that within my solution. And so that has the opportunity to reduce the complexity that comes with a multi-layered approach that typically exists in some areas of payments today. So moving on, let's talk about some specific opportunities. I'd like to start with business payments. B2B payments are considered one of the primary targets and one of the key opportunities for RTP. The reasons are a fewfold. First off, it's the timing. As I mentioned earlier, the absolute certainty and the absolute speed of RTP payments is hugely valuable to businesses. You think about paying a supplier, you think about waiting for your goods to be delivered. Perhaps I've got some big delivery to put out today, and I need to make sure that all the supplies I need to get out that delivery are on time. Now, the suppliers may not give me the supplies unless I've got the money, and by having real-time payments where I can see for absolute certainty that they have that money helps clear up a lot of confusion. Secondly, it's also the complexity across multiple parties and also on multiple channels, where today I might have multiple suppliers, and we might be using different vendor solutions for different things, whether it's on the receivable side or the payable side. Now we're helping simplify that, on top of communications that may occur outside of those solutions, such as a phone call or an email. And so the revenue opportunities here are huge. But again, similar to open banking, this isn't a revenue opportunity simply for the sake of being able to charge for something, but it's critically important to tie it to value. And there's a lot of opportunity to provide value to businesses in this area by leveraging RTP. And so there's a huge opportunity for value exchange. Secondly, there's also some opportunity to think about how businesses use third-party solutions today. That might be a little bit on the ERP and the accounting side, but also especially on the software solutions that specifically target accounts payable and accounts receivable and the whole source-to-settle process. Now, don't mean to imply that there's a huge threat, though there's certainly some impact to some of those providers. But on the positive side, there's actually a huge opportunity for banks and for these providers to talk about partnerships and how they can better work together. Those companies exist for a reason, and they provide great value. And although banks now have more opportunities and more options to provide more services to customers, there's still a huge opportunity for banks and those vendors to provide value together. And so I think it's a huge opportunity to think about how they can do that. Now, on the smaller corporate side, you think about smaller businesses, small to medium enterprises, where they don't have all the funds they'd love to invest into software and solutions to help them manage their business. And so you think about those types of businesses where they might not have a full ERP or accounting suite, or they might not have a full suite of software around their accounts payable or their accounts receivable or anything along those lines. Now, by a bank now being able to offer this real-time payment solution, now the bank is able to offer something to those businesses that is critical to helping them manage their business better. Now, where in the past they might not have been able to afford the proper solutions, now they can leverage something directly from their bank that helps with payment certainty, the speed of payment, but also the messaging and the data around those payments. And so really the greatest disruptions here and the greatest opportunities are that there's greater competition opportunities for FIs. There is some impact to the non-FI offerings, but again, I think that also creates opportunity for partnership. And third, there's reduced clutter around the communication and information sharing.
And so with that, I'd also like to move on to some other opportunities for RTP. First, I'd like to talk about bill pay. Bill pay is a huge opportunity for real-time payments for a couple of reasons. If you think about real-time payments in the world today and bill pay is done one of two ways usually. Either a customer will go to their bank's bill pay website or they will go to their biller website. One of the more common reasons customers will go to their biller's website to make a payment is because they want to know that the payment will be immediately applied and they want the acknowledgement or confirmation from their biller that the bill has indeed been paid. But if you think about what I mentioned around our real-time payments and the finality and the absolute certainty of it and also the ability to have acknowledgments, this creates a new opportunity to create new bill pay experiences using real-time payments and directly address those points that often lead customers to make bill payments at their biller's website. Second one, moving on to retail point of sale. Retail point of sale is an interesting one. Now, like many of you, I've been in the payments industry for a long time, and I'm not so naive to think that the retail point of sale environment can change overnight. And so I don't mean to imply that change there will occur in the next 1 to 2 or even the next 3 to 4 years. I think this one will certainly take time, but I also believe that with a new payment rail coming out, particularly given the speed and the certainty and the other benefits that come with it, there is certainly an opportunity for it to apply in a retail point of sale environment. And so I think there certainly are opportunities that are already being explored by retailers. And admittedly, they will take time, but I still nonetheless believe there's an opportunity there. Third one's a little bit easier when we talk about e-commerce. In the retail point of sale environment, you have to worry about adjusting all the hardware, the card readers, all the other point of sale hardware that is in play in today's environment. E-commerce is a little bit easier because you only have to worry about a website and changing some code. And so I think the e-commerce environment is similar to retail point of sale, but it can be addressed a little bit sooner. And I think similar to how you have other payment options trying to work their way into e-commerce sites, I think there's certainly an option for real-time payments to find its way into the e-commerce space in a little bit faster fashion. I think this is still a couple years away at least, as the industry currently focuses on adoption by banks and adoption by others in the market, but I nonetheless believe this is an opportunity. With that, I'll go ahead and turn it over to Wade for any questions we have from the audience.
Well, thank you, Greg. Appreciate the primer on real-time payments. We do have some questions here from the audience. We'll go to the first one. A big part of what you talked about here was the clearinghouse. And so our first question here reads this way. You've talked a lot about the clearinghouse's RTP solutions, but are there other real-time solutions in the market?
That's a great question, Wade. There are certainly other options out in the market. First, I'd say there's others that mimic real-time, and so I think first we have to start with the definition of what is real-time. If you talk about real-time payments, and what I've been talking about here, it's real-time payment, real-time settlement, everything, as we said, is instant within 15 seconds. The whole kit and caboodle, and it's irrevocable. But if you loosen the definition a little bit, you could think about things like Venmo and Zelle and other cases where it mimics a real-time customer for the end user, but on the back end, the payment may still flow through ACH or card rails or some other method that isn't truly real-time as far as the settlement of the payment and the finality of the payment. And so I think those are a couple examples where there are real-time mechanisms, although it's not as comprehensive as this new rail. Other examples could get into the distributed ledger and blockchain space. If you think about Ripple and things that they offer, that's certainly another real-time payment mechanism, again, depending on how you define it. So I think that's part of the answer. That being said, though, there are certainly other options. The Fed has recently issued a request for comment, actually, and they're seeking feedback in a couple areas around real-time payments. And so I think there's many in the industry that are looking at what the Fed's doing, what they're requesting comment for, and trying to understand what role they may play. And I certainly wouldn't mean to speak for the Fed, but I think to some degree it appears they're trying to figure out what's the best role for them to play as well. And so that's another option for real-time payments that, again, while we don't know where it's headed, it certainly is something that's out there in the industry, if you will.
Sounds good, Greg. Really appreciate those thoughts. We do have one more question in the queue here, and it actually has a little bit more to do with new players in the space. So Mary, I'd like to ask you this question. The question reads, what are the key factors that have enabled new fintechs to grow so rapidly?
Yeah, sure. Thanks, Wade. So fintechs, they've been enabled to grow rapidly because financial services are going digital. Consumers, they're expecting more and more from their banking experiences as a result, and then banks are looking to fintechs to help them solve their customers' needs, especially the needs that the banks can't solve in-house, or it doesn't make sense for them to create a new solution from scratch. So fintechs, they can also provide greater speed to market in an industry where there's a lot of pressure to show quick returns on investment. Banks tend to be slower the larger they are, and in many cases, they're powered by legacy mainframe systems. Fintechs are smaller and more nimble, and they can develop solutions quicker with less overhead. So for example, there aren't as many controls or lengthy approval processes slowing them down.
Excellent, excellent. Really appreciate those thoughts, Mary. We do have one more question in our queue here, probably the last one we have time for today. A reminder to all other questions we have in the queue. We'll get back to you via email. Greg, the question has an RTP slant to it, so I'll send it your way. The question reads, is there an expectation for all the RTP platforms around the globe to integrate? And what about foreign exchange?
I think there's a huge opportunity, and I laugh because I think real-time payments, to some degree, fails to live up to its potential if you don't address the international opportunities. And so I think that is certainly something that's in the plan. As I said earlier, some of the real-time payment schemes around the world have been adopted for some period of time, and so they're fairly well situated. But a lot of the more recent ones, including the one in the U.S., which, as we said, has just celebrated its first birthday, as well as some in the other countries, they're still working on getting full adoption across the country, or perhaps across different channels, or perhaps different parts of the industry. And so I think connection across all of the real-time payment rails across the world is certainly coming, but I think it's secondary in concern to making sure each of them is well adopted in their own countries and adopted for all the right use cases. Now, getting a little deeper on this, I think things that make it easier are that in some cases it's the same vendor. As I said, Vocalink, who is the provider behind TCH for the US rail, also provides the rail in the UK and Singapore and Thailand. Now, these are slightly different platforms, and I won't get into the details here, but there are nuances between them. And so while it's certainly not a one-to-one, having the same base provider certainly makes that easier. Another thing is also the message type. In the US, as well as many other parts of the world, we are adopting an ISO 20022 template or format for real-time payments. This is also being adopted in other parts of the US outside real-time payments. I believe it's also working its way towards Wire with a deadline, I think, of sometime in the early decade of 2020. And so having a similar vendor in some of the countries, plus having a similar format in many, if not all of the countries, and continuing to be adopted across the world will make that much easier when the time comes. But I certainly don't expect it to be something here in the next 6 to 12 months, for example.
Excellent, excellent. Well, thank you, Greg, for sharing those thoughts on RTP, as well as the primer on open banking. And thank you, Mary, for giving us some thoughts on the new players in the industry. So as our webinar comes to a close today, I'm happy to share a few suggestions on how you might start to think about impacts to your organization. First, we learned in the open banking section that it's more important than ever to plan on being more collaborative with others inside and outside of your own industry. And that's going to mean sharing things that you might have been holding very privately up to this point. But from our second section, we hope you have a very good basis of understanding on what types of partners you want to work with to create some new experiences for your customers. And finally, we learned that speed's everything in today's world, including in financial services and payments. To stay up with your competition, both in the traditional sense and against disruptors in your industry, plan on making strategic investments in technologies that enable your clients to conduct their businesses in real time. So as we wrap up, I'd like to say a very special thank you to our sponsors for this webinar, Red Hat and Intel. If you'd like more information about their product offerings, just reach out to your Red Hat or Intel representatives or call on us at Levvel to help you get connected. If you'd like to discuss the concepts we've discussed in this session and how they might pertain to your organization, by all means, reach out to us at payments@levvel.io. Thanks again for joining, and so long, everyone.